What is going on, Alpha Hunters? Hope you guys are doing well this Wednesday. It's a Wellness Wednesday, I guess. Yeah, let's call it Wellness Wednesday. I need to get the broker logged in too, but we are seeing the kind of start of the volatility that's going to basically about to happen here over the next about 10-15 minutes. And it's going to be a crazy one for sure, as the Fed's going to announce its interest rate hike decision, its Fed funds rate hike decision. SPY 380 end of day. Oh my gosh, bro! Don't even speak that evil, man. I'd be way more bearish than that. That's just my thinking, but yeah. I mean, we'll see. We'll see. How you doing, Brad? How you doing, bud? I mean, you saw it. Look at that. Already getting some spike movements coming in. Yeah, a lot of people trying to get. Yeah, that's my style, buddy. That's my style. You know how it is. You go big or go home. You go big or go home. So yeah, it's gonna be fun. It's gonna be a fun one to watch. I know Finance Yahoo will probably be covering it, so I might just leave it here. See if I can refresh. See if that's real time. Fed expected to raise rates 75 basis points. Let me see if I can get into Twitter. Yeah, let me kind of get some of this stuff going. Skip. Dang it, I don't care. Explore. Fed. All right, watch live. I mean, that's the press conference. That's the thing, is like there's so much like, hey, watch this, but it's the press conference. That's 30 minutes after they actually release their update on their policy or the Fed funds rate. So yeah, we'll have to just see what it comes in at. But let's just take a look around the market, see what's moving, what isn't. A lot of things are just flat. Consumer services are down a little bit. That's the one area looks a little bit more red than normal. Microsoft, Google, they've been hit pretty good over the past couple of weeks, so they're clawing back a little bit. A lot of tech actually up today. That's interesting. A lot of electronic technology. So a lot of the semiconductors are doing pretty good today. We're going to find out if they hold here in about 9 minutes. And for the 30 minutes after the top of the hour, it might not be a straight shot. You know, we might not just move in one direction, because this is going to be very key to understand. The press conference is going to be very important. It's going to be a lot of understanding what their thought process is. So after the top of the hour, we might just be super choppy and range bound. And then if, that would be very clear indication that if we haven't picked a direction by 2:30 Eastern, 1:30 my time, then we will have the press conference will be massively important. So if the market doesn't get the answer it's looking for, and we can tell if it gets the answer it's looking for, if the direction is already set in stone, like we're just going bearish, then that's probably the direction it's going to go. If it's going bullish, that's the direction it's going to go. But if it's just still chopping around, it'll be wild though. It'll be pretty wild. But if it hasn't really picked a direction, we can definitely see the press conference and the questions that come out of that is probably what will set the tone. Then once the market kind of gets its answer to specific questions, a lot of it's going to be around what their thought process is, what they're thinking. So yeah, we're seeing a lot of things that are bullish that haven't really been doing all that well. Transports are up, so a lot of people are buying ahead of the Fed, which I don't know about that, man. I don't know about that. I don't know about all that. Yeah, we're gonna see how it goes. We are gonna see how it goes. Let me see. Um, I'm gonna see if I can do this after Fed. What up, Diet? How you doing, buddy? Uh, let me see. Let me see. Let me see them votes come in. Oh man. I love it. Never done a poll before. Good time to try it, right? So yeah, we're gonna see what the market's gonna do here very soon, very shortly. And yeah, it might take about 30 minutes for it to really kind of figure it out. It might get all the way to the press conference, so don't expect like a rapid move right away. Because I think most people already know that they're going to do 75 basis points. So if they come out and say 75 basis points, okay, that's not going to move the market. We're then going to have to see what they say in the press conference. So just keep that in mind. But we are seeing some buying actually out there. Let me look at Apple real quick. Apple, it was sorry about that. It was kind of loud. Apple was kind of weak earlier, but it has climbed back a little bit to be in par roughly with the market. And Apple, shoot, over the past 2 days was really strong. A lot of buying coming in, kind of just getting to the top end of this downward channel. It's kind of been in for about the past month, so we'll see if it kind of breaks through today. But even if the market does go bullish today, I'm going to call out this May 4th movement. This movement that we had back on May the 4th was a very strong bullish move. It did not take out the preceding highs from the week before, basically. But this was a Fed day. Okay, this was a Fed day, and the market was just kind of hanging out. And then once the press conference kind of got going and underway, and they found out what they wanted to know, the market just screamed higher. The next day, then opened down and just traded lower, took out that entire day. So just you got to keep that in mind if on what your expectations are coming out of it. Even if we do have a very strong bullish day in a downward channel, it just might be a retest. Okay, so just kind of keep that in mind. That even though we see some bullishness come in today, it might not hold through the end of the week. That'd be the main thing. Is if it holds through the end of the week, that would be a little bit more significant than if it just retests today and then it sells back off Thursday, Friday. All right, we are 3 minutes away. 3 minutes away. All right. Anybody watching anything specific today? Anything specific? Oh man, it is going to be crazy. I'm really kind of curious, man. Really curious to see which way the market does pick. Does the market give a shit about 75 basis points or 100 basis points, or do they give a shit about what the Fed is expecting going forward? Because I think everybody knows like 75 basis points is pretty much a lock. Possible 100 basis points, and if it does get, obviously, if it does get 100 basis points, I think we'll see selling immediately. We will see selling immediately come into the market. What would be very interesting to know is if we do get 75 basis points, do we just chop until we get to the press conference about 30 minutes after the announcement is made? That'll be very interesting to see if that happens. Okay, so Just trying to get some things going on the side screens over here. We'll just kind of watch the market here on the main screen. And yeah, we're gonna see what's about to happen. Got 60 seconds. I feel like it's like we're counting down to a launch. I don't know. We're gonna launch to the bottom. We're gonna launch to the moon, man. It's gonna be interesting. Yeah, this is gonna be real interesting. Oof. Should have asked. What do you guys think that if we get 100 basis point increase, do we just drop like a rock, not even wait for the press conference? I would think so. That's kind of what I'm thinking. But if we get 75, I'd imagine we just chop. It'll be wild. Like it'll be real wild. It'll be just choppy for about 30 minutes. I think we'll get to the press conference. So people trying to make early bets and watching that buying come in. People watching them early bets right there. All right. Oop. All right. Let's see if taken down. Is that day lows? That's day lows right there. And it took out them early betters real quick. Let's see. Let me know if y'all see the update. I don't ever know how to track this crap. 75. 75. That's what it was. Okay. Let me see if I can edit this. Nope. Can't do that. So we got 75 basis point increase is what it was. So, yep. Ooh, market not even waiting, man. We're just seeing the selling come in right. Ooh, look at that! Look at that 1 minute candle. That was 4 whole points right there. 4 whole points. That's over 1%. So we're definitely getting down to the lows of yesterday. We took out the lows then of Friday, Monday. Let me go to a 5 minute. There we go. But yeah, we're getting to the lows of yesterday. It's gonna be kind of hard to break through that in the first like few minutes. I'd imagine we'll probably at least chop around, if not see some buying come in, and then break it down in a few minutes after that if it's actually gonna break through and hold. But yeah, that's a quick move. I just saw the P&L change dramatically in the account. Oh man, it is crazy some of these swings the market has. Let's just take a look at the Qs. Qs did not break yesterday's low. Actually, Qs actually yesterday did not break the lows of Friday or Monday. So something to kind of keep an eye on there on the Qs. Apple definitely broke today's lows, but obviously they didn't break yesterday's lows or Friday's lows. Take a look here on the 1 minute. If it comes back and climbs back up to the top, man, it might just shoot higher. 100 basis points fire sale. Well, we're not going to get the 100 basis point fire sale, which is really kind of a bummer, honestly. Bummer. Real bummer. See what some of these other stocks, smaller stocks, do they get impacted all that much? They really kind of don't. They're really kind of just around where they were before, a few minutes before. So, yeah, small stocks don't really get impacted all that much. The area that gets impacted a lot by these decisions is going to be financials. So, financials, up pretty good actually today for the most part. Oh my gosh, that was a really bright flash. They were up early, pretty good. It looks like Goldman Sachs at least was trending higher. Bank of America was not. Bank of America was actually down. Okay, JP Morgan then? JP Morgan was down before. Okay, interesting. So they all kind of just snapped to their daily lows on that, though. It seemed like some of these banks had some early selling and then just some choppiness throughout the day. But except for Goldman Sachs, seems like they actually had some buying come in after that initial sell down on the market. Yeah. I do think though, if the market does break the low of yesterday, as long as it can hold down there, like maybe at least 10, 15 minutes below the low of yesterday, it could be game on for sellers. It could be game on. We're definitely seeing some selling come out of Apple though. I mean, look at that volume on Apple. I mean, I know the SPY is getting a lot of volume coming in right now. Q's definitely getting a lot of volume. One thing that you don't want to see, if you're a bear, you definitely, if you're trying to be bearish on the market, get into the lows of like a previous day or a key low level, kind of like how we are now, kind of at the lows of yesterday. If you do not break through, and you waste this much volume and this much strength of a selling move, you basically will just turn it over and just go bearish. So, okay, so we just broke yesterday's low. So that was the key spot. Basically 381.20. So, geez, we did it in 5 minutes. 5 minutes. So, it needs to hold below it. Anytime over the next 10 minutes, 10, 15 minutes, I would say, yeah, I would say before they come on, probably over the next 25 minutes, before they come on the press conference, this cannot really get back over that 381. Actually, I would say even higher than that. Probably 382.50. It cannot get back over that and hold. I know it just like in 5 minutes just took out that low, basically, but there will be some buyers come back in right here, kind of push it back up, but it cannot get back over like this 383 area and hold over that. What was this low? Yeah, basically 382.50. Basically the low from Friday, Monday. You don't want to see it get back over that and hold. That'll be a little bit more bullish because that's just basically a lot of buyers were sitting below the low of yesterday, and we just long barred all the way down, snagged the buyers, and the buyers are going to push it back up. You got to be real careful about that. But yeah, if you're looking for the short-term move on being bearish, I think that might have been a pretty good snag just to go ahead and get out right there from pre-Fed announcement to post-Fed. I think that's a pretty good spot to go ahead and close out a bearish position, see how it sets up from here, and probably go from there as to if you want to be bullish or bearish. But I mean, in 5 minutes, I mean, we did take that out. So I mean, it could also just keep rolling down. But I don't like seeing long bars that go just straight and take out a long or a key level. So like yesterday's low, right? I don't like seeing that because typically there's going to be buying power there, and it takes a lot of power to get all the way down there and take that level. So we'll have to see if the sellers just exhausted their power on that first 5 minutes, and if they're gonna just get taken back to the woodshed and back to the bullish side. Kind of surprised that they don't have this live going, or they're not talking about it. Bloomberg TV is. I see that on Twitter. Kind of curious to see what's gonna get hit out there. So the heat map hasn't really updated. Let me see if I can get this updated. This might be lagging behind. I didn't realize this thing lagged behind that much. It's fine. It's kind of a bummer, actually, that it does lag behind. I wanted to see what was moving pre and post. All right, so all right. Let's move on. I really want to see what the press conference is going to be about. That'll be about 20 minutes or so. As long as Finance Yahoo has it, they have had the previous ones. I'll turn the audio on for that. I'll turn the audio on for that, and then we can definitely see what they talk about for their plans going forward, what their expectations are, any other data that they are seeing that the market doesn't really pay attention to. Yeah, that was kind of one thing I was a little worried about is just having a long bar all the way down to yesterday's low, taking it out, and then you just get buyers sitting there waiting for it. So it seems like the real move is going to happen at the press conference. People are going to want to know what the Fed is expecting because, like, we're not just trending in one direction. Like, you're getting buyers to come back in. Yeah. So it seems like we'll probably have to wait 20 minutes to get like the continuation of a move. And it probably won't be looking too good. My expectation won't be looking too good. If you guys got any questions, let me know, and we can definitely take a look at some things. But I think the market's going to be pretty choppy until we get to the press conference on the Fed here in about 20 minutes. Let's check out Microsoft. See, did they take Microsoft and Google take out like yesterday's lows? No. Not looking horrible. So things aren't looking horrible yet. Google is actually still trading, continuing to make lows today. Okay. Microsoft was not. It was looking okay there. Amazon continuing downward trends, breaking the lows from last Friday. Yeah, last Friday. Interesting. Netflix holding tough, man. That thing's holding tough. It just got rocked so hard in the first half of the year. Meta continuing to break down even more today. Obviously with that post-Fed meeting. Dude, my puts, I bought this AM are all over the place. Oh, I bet they are all over the place. Yeah. It's crazy world out there right now. Crazy moves, man. Implied volatility probably spiked and it's crashing. Yeah, it's nuts. What's up, Sub? How you doing, brother? Does the stock reverse tomorrow even is a bull or bear today? Dude, I you know what? I'll tell you what, ask me that in 30 minutes. Ask me that in about 30 minutes. So the press conference is going to happen in about 20 minutes at the halfway point of the hour. That's a great question. Honestly, I think we're so close to these the yearly lows down here. If we do wind up breaking bearish, Sub, I think we're just gonna rock all the way down under 370, right into the top end of this blue box. If it gets under this blue box, there's gonna be buyers right here. That's where they bought previously back in June to make the low for the year. So I think if we keep coming down over the next next few trading sessions, even into early next week, if we get down there early next week, I think there's just gonna be buyers there. If you've been bearish during this move that we've had going since the middle part of August, I think that would be a good time to take off some of the bearish plays and just wait for the retest. Because I think that we'll get a retest that comes back up in August, and then you can probably reload then on bearish plays. I don't think we're gonna reverse here, honestly, unless if we do pop bullish today. Back on May the 4th, this was also another Fed day, and it was just hanging out. We popped very strong that day. It was up over 3%. The next day, we gapped down, traded down, and took out that entire day. So even if we do pop bullish today, it's going to be a little rough unless we can hold the week above probably 390. If they can close the week over 390, it might be on a way for a nice little retest higher, maybe back into 400 before maybe it continues back down. But I think we're just far enough down into this lows here. I think we'll just push down to below 370. And then at that point in time, I do think we'll probably see the bounce. Because there's just going to be buyers sitting down here. People are about to give up. Like, okay, we're getting down there. Forget it. Let's just get it over with. Let's get back down there, buy at really good levels, and then push back up. And then we'll probably chop around in here for, who knows, maybe a month. couple $100 in the green, then a couple hundred in the red, just switching back and forth. Yeah, man, dude, it's crazy, right? You gotta love Fed Day, man. Fed Day's fun day, man. That P&L be doing all kind of funny stuff. Yeah, it's nuts. It's nuts. But all right, another 15 minutes until that press conference, and the market's starting to just kind of hang low. It doesn't seem like we're gonna get bullishness to come in today. It doesn't seem like it because that was the bounce, right? We first 5 minutes we took out yesterday's low. We had the bounce. It didn't hold over 383. That was kind of an area I was kind of talking about, 382 and a half to 383. It was kind of like that area that it needed to really hold over. It got basically to that spot and has now rolled back down. It's now just kind of continuing to slowly roll back down. It's back below yesterday's lows. So, yeah, if it just continues to just trade lower, it's just going to continue to trade lower. People are going to give up on trying to buy the dips because there's not a lot of structure in here from the previous few months when we were back down in these levels back in June, July. So there's not really good structure. There's some okay structure in here. There's obviously buying levels. There's an okay one here at 375, but I think the big ones are right here at 370 and down 370 to 360. Kind of my thinking, at least. So yeah, we'll have to see what happens over the next few days, going into the end of the week, beginning of next week. But yeah, I'm really interested to see, man, that 15-minute is nasty. That is freaking nasty, dude. That is crazy. Look at that. It's just, if you just look at the 15-minute, just looking back at the past like 2 weeks, it's just come back. It came down, chop. It slowly broke down through the 390 area, broke through, and it was just choppy here from 382 to 388. It was just in a choppy consolidation zone. And so here over the next hour, if it can just continue to push lower and just have a couple 15-minute candles where it just holds below the 382 level, because obviously there's buyers right here. There's buyers here at this 382 level. They've been trying to buy here. They did it back on the 16th. They did it on the 19th. They did it on the 20th. They're still fighting a little bit right now, but it's just kind of getting, the buying's just getting sucked up to where it might not hold here much longer. Might not hold. Buyers are just not good suckers today, I guess. Or maybe they are suckers. I don't know. Maybe the bulls are maybe the bears are suckers, trying to be like, haha, I told you it's gonna go bearish. And then they get sucked in and bulls come in and buy it up. Apple. I'm really curious to see what happens with Apple. Obviously, the past 2 days were extremely bullish. Comparing to what the market did. I mean, Apple was just killing it. Qs and SPY just not doing a whole lot compared to what Apple did. Apple was just absolutely monster over the past 2 days, but very much could take out that bullish candle from yesterday today. If it gets back down and engulfs that, people are going to come back in and sell it. So we'll just have to see. The thing about Apple though is it had this little support and resistance area like right there. It kind of got close to it. It didn't fully get there. There's another one like right there because that's basically the open area of that gap. So that's kind of where it just got to this morning and has since sold off. So it'd just be interesting to see really what kind of happens over the next hour, 40 minutes, kind of how we close out the day. It's going to be really interesting to see what happens. But I do enjoy seeing the market move like this. It's fun. I don't care to trade this stuff anymore because my buddy Diet has already said, it is crazy, man. Your P&L is just it's in the heavens and it's in the hells. And it happens over a split second. It's just crazy the kind of moves you get, man. But I think, man, this is starting to set up pretty bearish. It's starting to set up pretty bearish. You had this, obviously, this 5-minute candle, long bar. As soon as we got the rate decision, a little bit of a retest, bearish engulfing candle. Then on the third 5-minute candle after the top of the hour, and now you're just kind of getting an upper wick before the breakdown at the lows of the previous 3 candles. So we'll see, man, kind of how this next minute plays out. But if it's not starting to turn like really solidly bullish, it needs to probably get over like 381.80 at least here in this next 40 seconds before if it doesn't do that, I guess it's probably going to break down pretty strong here soon. But yeah, the market's just holding on right here. Like, it just seems like, yep, sellers came in. Now everybody's just kind of waiting for the press conference and, you know, the mindset and the thinking behind what's kind of coming forward. You know, most people thought we were going to sit 75 basis points. Now people want to know, you know, what's coming forward, you know, down the line for the next few months, even into next year, so they can rebalance portfolios, readjust their investment plans. This actually kind of sets up a little bullish too. Jeez. You know, you had this breakdown, retest, comes back down, doesn't take out the low. If we start to rally here and take out that high right there, that'll be pretty bullish. That'll be pretty bullish. You gonna show the conference on your stream? Yeah, man. I'm gonna might not show the conference, but I'll at least have the audio going. I'm expecting Finance Yahoo to have it. They usually do have it. Trying to get to live. I think that's live right there. Yeah, so you can see, we looked at this just a bit ago. A lot of it was green, some scattering of, a lot of it was gray. Yeah, I could definitely pull it up on the YouTube channel. Actually, you know what? I'm gonna do that. Just a safe bet. Let me do that. I'll get that. All right. There you go. All right. I'm going to turn this music down really low. That way we don't have to watch it. But if something starts happening, I want to be able to hear that something's happening. I guess we can switch over to it a little bit and I can turn that volume back up. All right. Thanks, Diet, for the suggestion. They have some guy on it on an interview now. Wait, what? What guy? What guy's on an interview? Student loan forgiveness faces a challenging road ahead. The Buffett indicator says the stock market. They actually have 2 live streams. Oh, they have 2. I care more about the press conference. I don't care about what anybody else says. I want to know what the Fed chairman says. Because most of like, they're not, whoever they're interviewing, they're not going to say anything that, you know, the Fed chairman is going to want to have full control over the what's being voiced about the committee's decision. So nobody else is gonna, somebody's not gonna go out there and front run him about what he's gonna talk about. On the same channel, didn't know that was the thing on YouTube. Yeah, I didn't know that was the thing either. Are you sure? Because the only thing I saw that was live on this channel it's just this press conference. That's the only thing I see that's live. So yeah, if they're running multiple things, that's interesting. Very interesting. Ooh, man, we are definitely seeing them buyers come in at these levels, at these lows. That's kind of interesting, though. Kind of just where we are now. If we end the day kind of like this, we just chop around, just kind of end the day like this. I still think it looks more bearish. It's starting to slowly break down. So I still think that'll be a little bit more bearish. No, there is one called Market Covers and another one called Bank CEOs. Okay. Yeah, it's gonna be real interesting to see what they talk about. Let me see here. Fed again hikes rates by 75 basis points in aggressive bid to fight inflation. Let me read through this actually real quick. We're in to a new range of 3 to 325, highest level since 2008. A current range of 325 to 35, blah blah blah. I'm trying to see if they did say anything about the dot plot. People want to know about the dot plot. The dot plot is the future expectation of where the Fed funds rate will be. You know, so like going into next year, what the Fed is thinking about continuing of raising interest rates, or their expectation of when they can start decreasing interest rates or cutting them back and that kind of stuff. So we'll see what we get out of possibly the dot plot. I don't see anything here talking about that. So, oh, hold up. What was that? Hold on. That was the Fed continues to see inflation. Officials see inflation rising 5.4 this year, and excluding volatile food and energy prices. Oh, okay. 5.4 this year headline, excluding food and energy, up 4.5 this year. 4.5% this year. However, officials expect inflation next year to come down 2.8% to 3.1% on a core basis. It's not until 2024 that officials expect inflation to get back closer to 2%. The Fed's target. Officials project 2.3% in 2024, followed by 2% in 2025. So yeah, they expect inflation to kind of be around even into next year pretty good. And I mean, if that's their so this is their expectation on inflation. The thing that we want to know, okay, is we want to know if that's their expectation on inflation. What was their plan around interest rates to come up with this inflation expectations? Like, if that's their inflation expectations, are they cutting the Fed funds rate around this? And what is that expectation of the Fed funds rate? Okay, so that's what we want to know. That's what's going to drive the market. You know, maybe not we want to know, but that's what's going to drive the market. All right. About 3 minutes, the Fed chairman will be doing his press conference, and we will probably get the other end of this story real quick. He'll probably have a statement, probably go on for maybe 3 to 5 minutes, and then it'll be time for questions, and that'll be interesting. This is going to be the question time. Very, very rarely does he actually answer the market's question of what the market's wanting to know. All right. Okay, it's such a bummer, you know, when you want to get in here and you just want to know what you want to know. I just want to know what I want to know and I want to move on. It's a bummer to wait. It's a bummer to wait. Seems like there's a nice little run on tech there. About 10 minutes. Nice little buying up on tech. Seems like it was a little bit stronger on the tech side than the SPY was. I want to see how some of these other things move, like the dollar, because the dollar was, oh man, look at that explosion on the dollar today. So the dollar pre-Fed, yeah, it was already kind of breaking out. And look at that explosion today on the dollar. The TNX kind of staying level. All right. Had an explosion higher, and then just kind of hanging out, coming down. Oh, you know what? I can't do that. Oh, the inversion yield is going lower. Let me turn the log off. Yeah, wow. It might make, the inversion yield might make a new low for there. Let me check the 2-year. 2-year. Man, look at that 2-year. That 2-year is skyrocketing, up over 4%. Okay. So it should be go time for that press conference. GLD, gold hanging out. HYG, high yield corporate bonds. Going a little bit lower. VIX, what are you doing, VIX? Okay. VIX is lagging on this. All right. Has not said anything yet. Here we go. It's go time. It's go time.
Our 2% goal.
All right. Well, I was retarded. Sorry. What?
Of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the Consumer Price Index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country, Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular: to achieve a period of growth below trend, and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market.
It's key.
So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Thank you, Mr. Chairman. Steve Leisman,
He always
CNBC.
asks good questions.
Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today, we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Rachel. Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
So he just mentioned something right there that was very
Still
crucial.
at the top of your list in terms
I'm about to mute that real quick. Hey, so he just mentioned that he said something about the soft landing probabilities not really being that good, or just having to be more restrictive on policies that could damage even a soft landing or make it more of a hard landing. So he was actually basically saying that that's a higher likelihood. So just kind of interesting right there.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see.
Hey guys, I mostly think really for the stock market today, I think we're going to be, I know I'll mute the Fed guy here in a sec, pal. But I think we're probably just going to be choppy, neutral to bearish, probably going through the rest of today's trading action. Okay. I don't think we're going to see much more bullishness. I think getting back below this Fed high was very important. I would have rather seen a bounce there and a continuation higher. But the fact that we were just kind of getting back below it, I think will be more flat, choppy to bearish, going back down to the day's lows, possibly.
For the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate? You're
right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
But how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
All right. I was actually going to cut it off at that last question, but he asked about recession possibilities, I guess. And basically, the Fed, yeah, kind of just the chairman there, Mr. Powell, just basically said lower growth. He didn't want to commit to answering the likelihood of a recession off of that question. That was actually that was kind of his way of dodging it, basically saying, yeah, I think I think it could happen. Because he said, yeah, we do expect to see really low growth, but wouldn't go into the recession word. He did mention recession or really low growth a few times in that little press conference. You saw the market kind of bounce back. After the Fed funds rate decision of 75 basis points, we saw it kind of come down, snap yesterday's low. I did mention, that would be a good time to just take if you had short-term bearish positions on, basically just like a a Fed bet on it going bearish, like that was the spot to probably take it off. And I mentioned like getting in over the 383 area and holding over that's going to be kind of a bullish spot. It didn't do it for the 10 minutes after that initial 5 minutes. Came down. I thought it might actually roll back over and go down and snap it, but it didn't. It actually held, and then it snapped over that 383 level and went and took out the day's high. But I don't think we're going to see much movement outside of either end. I think we're going to probably just be choppy in here, probably just trade a little bit bearish. And I think that bearishness will continue into tomorrow and Friday. I think we'll probably end the week on a bearish note. I think we'll probably just continue to trade down as we go into the close on the 23rd, Friday. I don't know, man. It's gonna be kind of tough to see. Like if we start to really kind of get weak into the last hour, as we go into the latter parts of the hour into the close, maybe we break the day's low. But I'd imagine we probably just kind of come down and settle in the middle area of basically this Fed movement that we saw here in the middle part of the day. So that's really kind of all I got. I mean, they skirted it like they do a lot of times, but they said, or he said, really, Mr. Powell said the same thing that they've been saying all year. We are committed to getting inflation down to 2%. We were going to continue to raise rates where we need to. He also did say that they are data dependent. They are going to continue to watch the data. People did ask about possibility of slowing down, selling off the balance sheet, or because the Fed is on also, this is the other thing to really watch out for, though, is the Fed is shrinking their balance sheet. And this is the first time they've done this in a very, very long time, decades. Okay. It's been a couple decades. So they started doing this in June. And there's been a lot of reports out from bonds and the treasury market people and some articles that are basically saying, hey, like we're seeing a real lack of liquidity, which a lack of liquidity in these markets are supposed to provide liquidity to investors. And if they're not providing liquidity, that's a very bad situation. And let me go back to really, let me just go to a monthly chart. That's really kind of what led to the 2008 and 2009 being as bad as it was of a market crash. Was the liquidity dried up because nobody wanted to invest in real estate, and real estate was a bedrock to providing liquidity into other areas of the financial system. So when all that liquidity got sucked out, we just saw massive volatility movements. So that is another thing that's really important that needs to be watched now and these days, because if the bond market people are talking about bad liquidity, that's something very much to be paying attention to. So they did talk. Someone did ask a question about that. If they saw any deterioration in like the real estate market, would they not continue to sell off, treasury assets, or not treasury, the Fed assets and stuff like that, continue to shrink the balance sheet? And he said, you know what? We have not thought about that. Like, so to me, that is one of the most bearish things that he said in that whole press conference was we are not looking to slow down our pace of selling off our assets and are shrinking our balance sheet. Like they are committed to it. That's basically what he said with that statement. So there was nothing out of today that is getting me to change my mind. I'm also like, if you're just watching the market, like this rally that we had, basically from when the Fed press conference started for about the 15 minutes after was very strong, very strong. Went from the lows of the day, took out the highs of the day, went a little bit higher, got to 389. So we went up like 9 points, roughly in about 15 minutes. That was actually a pretty impressive move, but that was it. And then you've seen it get back below the pre-Fed high, before the Fed announcement. So to me, it's just going to be choppy today, but I still think we're in a bullish trend. I think we'll probably come out of this tomorrow, probably a little bit more bullish or choppy, maybe sideways. I don't see us having a bullish retracement higher. Maybe we go sideways, but I think we're just going to continue to go bearish until we get down into the below 370 zone. And then at that point in time, I think we probably see some bullishness there. So is that an engulfing candle you were talking about? Which one on like what time frame, Diet? Give me like specifics. I know we're on a little bit of a lag there, but so like the 5 minute. So there's an engulfing candle here, right? There's an engulfing candle here. This 5 minute, and this was actually really crucial because we saw a massive long bar all the way down to the lows of the weekly. Okay, I'll look at the weekly. And then saw that buy up, and then that third 5 minute candle after the 75 basis point announcement, we saw that bearish engulfing. But if you're looking at a weekly, last week's weekly, if this is the one you're talking about, last week's weekly was a bearish engulfing. That was not good. And what was interesting is, I'll just go to a daily real quick. Monday, I actually thought that might have been enough of a retest. But here's the thing: is we took it out. We took out Monday's high. During the press conference, and we actually retested a little bit higher, which that was probably the zone I thought we'd get to on a retest, was about the 389 to 390 area. So we did get a little bit more into that retest. That was a little bit more of the sweet spot of the retest zone. So that was another reason why I was like, I'm not looking to be bullish at all, because we needed to get over 390 and really hold over for a close of the week. And really, man, you really want to see it get over, probably like 393. You really want to see it back over this level. I don't think that's happening now, and we're definitely seeing that selling coming back in now. I think the press conference probably mostly done. I think everybody's got the information they needed to know about the Fed, their mindset, what they're thinking about going forward. They're still data dependent. They're not going to look to slow down their Fed asset sell-off. They're going to continue full steam ahead with that. That was my biggest takeaway. That was like one thing that they are not waffling about. And if they are going to continue to sell off assets, and people are already talking about like poor liquidity conditions in some of these massive markets, in the treasury market for I know retail investors and retail traders, they pay attention to like the stock market, man. But I understand something. Big dogs. I'm talking like governments, big time pension funds, big time hedge funds. They pay attention to the treasury markets. Like there is treasuries all over the world. And if that market is having issues with liquidity, it spills over to all other areas of the marketplace. Or the financial market world. So that is something that will definitely be paid attention to by financial professionals. So if those areas are having issues, be very cautious on the stock market, because liquidity out of the stock market, if for what you think or how liquid the stock market is, it's actually not as liquid as some of these other markets, and the treasury market is a highly liquid one. So just be very, and the currency markets are highly liquid. They're not highly liquid. They're more liquid than the stock market. The stock market is not as liquid as what you might think as other financial markets. So just be a little cautious about trying to be bullish, man, because there's any minute, man, with liquidity just getting sucked up, getting dried out. You can see the drop of a hat, and things just start just dominoing. So just be careful on things, but you're not seeing the follow through on the bullish side. You're right. You're not seeing that follow through. Like, if we just look at the 60-minute, like that was a 60-minute, took out the weekly high. Now we've traded back down. Like it's either we're going to trade side or we're going to trade down. Like you didn't want to see it come back down into this zone. We're seeing some bullishness come back in, but it just might retest into some of these lows, like right here, basically kind of like how it just did. But that's really kind of all I got, man. Fed giving us what he's kind of given us for most of the year, to be pretty honest. Like he didn't say anything outside of what he's already been telling us for past several months. So to me, I like staying bearish here. The market's also not screaming, hey, you know what? It's time to change the tune. You know, we're just seeing the market chop. I mean, we're only up 0.4%. So I'm not seeing the buying action kind of come in. Maybe it does here in the last 45 minutes, but I'm still not seeing it. So, all right, guys. Just remember, I'm not going to be live streaming tomorrow and Friday. I'm actually going to be driving to the coast tomorrow, and then I will be out in the middle of the Gulf of Mexico on Friday. So no live stream for me. So you know what that means. The market will probably be chaotic, and I won't be here to witness it. I should be back on a live stream Monday and Tuesday of next week, and then I have an obligation for like 2 weeks after that, roughly, up in Dallas. I'm going to try and live stream. I'm going to try to get a setup going, but I don't know how. I'm not going to commit to it right now. So some things for me to work through over the next couple of weeks, but it doesn't matter. I will I'm actually going to put out a market outlook video today after the bell, just kind of see how it closes. And then just kind of my expectations kind of going forward the next few days. I'll be back on the mic on Monday. Alpha Hunters, y'all take care. Have a great week. Have a great weekend. And I will talk to y'all later. Have a good one, guys.